This episode is sponsored by Lupton Capital, which provides a variety of investment services to both retail and institutional investors on platforms such as Seeking Alpha, Substack, and StockTwits. For more information on these services or for links to those services, please visit luptoncapital.com. Hey, everybody, this is Jonah Lupton. Welcome back to the Investing with the Whales podcast. Very excited today for my guest. It is Asif Suria from Inside Arbitrage. Asif, how are you?
Doing great, Jonah. Thanks for having me on your podcast.
Oh, absolutely. So you're out on the West Coast, right? Near Silicon Valley?
Yeah, I live in the San Francisco Bay Area, about midway between Silicon Valley and the city of San Francisco.
Awesome. So this will be a little bit different. Typically, we talk to investors, we talk to traders. I know you're an investor, but you're more focused on event-driven opportunities and arbitrage. Besides those two things, what do you focus on?
Yeah, as you mentioned, we mostly focus on event-driven strategies. That could be anything like merger arbitrage. It could be SPACs, spin-offs, management changes, and things like that. And then there are things that are related to event-driven, but not exactly event-driven. So there are things like insider buying and selling, which we've been tracking that for a really long time as well. So we yeah, go ahead.
I was going to say, you run a website called insidearbitrage.com. So all of that is on the website for subscribers?
That's right. So we have 7 different strategies we are tracking on the website. We launched about 6 years ago with just merger arbitrage and insider transactions, and then over time expanded to 7 strategies.
Out of those strategies, which one is the most common?
The one that attracts the most interest is merger arbitrage, especially in like markets like we had last year. So when you have markets that are trending down, investors might flock to merger arbitrage because it creates a little bit of a counter-cyclical option, something to invest in instead of just standard stocks or bonds. So people flock to merger arbitrage a lot, and then obviously insider buying attracts a lot of attention as well.
So as the name suggests, when I think of merger arbitrage, I think of, you need mergers and acquisitions for it, right? You have a company, a $100 billion public company buying a $5 billion private company at a 30% premium, but it's really not going to trade all the way up to that premium until it closes. So there's always a little bit of an arbitrage for certain investors to play, typically with leverage, right? So as that deal closes, maybe they buy it at 25, the deal closes at 30, they make that $5 times leverage, whatever. I mean, is it as simple as that, or is it more to it that I'm missing?
It is as simple as that, and then there are nuances to it. So you described it exactly right. And a good example of that would be Microsoft attempting to buy Activision Blizzard. So they're trying to buy Activision at $95 a share. It's an all-cash deal. Activision currently trades at about $77 a share. So you have the option to pick up $18 in profits if the deal closes.
If the deal closes, right? Exactly. Right. That's a big if right now.
That's a big if, because you have a lot of regulators that look at these deals. You might have the FTC or the Department of Justice in the US that might look at it. You have the CMA in the UK that's looking at it. Europe is looking at it. So these deals have to go through regulatory approvals. They have to go through shareholder approvals and things like that. So we track all of those events that happen after a deal is announced. And so we track them from announcement to completion.
What's the trend been like the last 12 months versus the last 5 or 6 years since you launched the website? Are you seeing fewer deals now, more deals now?
Strangely enough, we haven't seen the deal flow slow down. We have anywhere from 80 to 100 deals that are active at any given point in time.
Wow. Okay, that's way more than I would have expected.
Yeah, it's 80 to 100 deals. So that's why it makes it a little bit complex, because you have to track every single deal that's announced, and then you have to track them to closing. And then we track the spreads for each of those deals. So how much is the spread on the Activision deal? How much is the spread on, for example, Spirit Airlines, which JetBlue is acquiring?
Oh, I forgot about that.
Yep.
Is that still going through?
It's still going. It hasn't gone through yet. So there was this whole bidding war between Frontier Airlines and JetBlue for Spirit, and they kept raising the price until JetBlue won the war. Now, the bigger challenge for them is getting regulatory approvals, because airline deals always are scrutinized quite a bit, and that's where the risk lies there.
And I assume you, depending on the industry, you see that regulatory approval take longer, right? I mean, like you said, an airline deal might take longer than a software deal, but if that software deal includes Microsoft or Google, it's more likely to get broken up than if, or blocked than if it's like a private equity firm like Vista, that's buying, a software company, right? Those PE deals probably don't get blocked very often.
That's exactly right. So the private equity firm deals aren't blocked, except when the Federal Trade Commission sees a bunch of private equity firms buying multiple companies in the same segment. So if you start seeing Vista buying 3 or 4 different cybersecurity companies, then they might take a closer look at something like that. But for the most part, most deals close in about 120 days. So in about 4 months, most of the deals close.
So you have seen Vista and I think it's Thomas Bravo, get pretty active the last year. Do you think they're going to start running into some regulatory problems because they've been so active?
I think so. If they continue being this active, they're going to run into regulatory issues. There's also, the PE cycle might change. Money was so cheap for them for so long, and that's going to change. And I think that's going to create a little bit of an issue for deal flow for the private equity firms.
Now, do you guys provide any sort of like probability of a deal closing or not closing, or is that up to the investors to try to figure out, and you guys are just focused on what the actual financial arbitrage is and then leave the risk of the deal to someone else?
So we do 2 different things. On the one hand, we have tools like our merger arbitrage tool that lists all the deals and it shows you the spreads and the annualized returns. Because if a deal closes in 3 months and you get 10% returns, your annualized returns are almost 40% if you can find 3 more of those kind of deals.
Yeah, right.
We do that, and then we also provide analysis. So once a month, we publish a special situations newsletter. It's almost as big as a book sometimes, 42 pages, the last one. And that includes analysis about what we think about specific deals. So the one we wrote about 2 days ago was Oak Street Health, which is being acquired by CVS, and there's a 10% spread on that deal. So we dove deep into that deal to analyze it, see how it looks like in comparison to other deals that have gone through or not gone through.
Do you still see that spread narrow from when the deal is announced? Does it just keep getting more and more narrow as you get closer to the deal closing? Or like in the case of Microsoft and Activision, that one seems to be getting wider now?
Yeah, and that's an excellent question, because there's some academic research that shows that the trend of the spread is important. If you start seeing that a deal starts at a large spread and then the spread continues to widen, there's a high risk that that deal will fail. If you see that the spread is narrowing, as in, it's the discount is getting less and less each day, that's positive for the deal. It looks like the deal might close. So what we've seen, Jonah, by looking at about 12 years of our data, is 95% of all deals close. Even in a year like 2020, when, for example, LVMH tried to pull out of the Tiffany deal, 90% of those deals ended up closing as well.
Interesting. Okay, that's higher than I would have expected as well.
Yep.
And then once in a while, those deals close, but at a renegotiated price, right?
That's correct. I mean, you saw that with Elon Musk and Twitter last year. He tried to renegotiate that price by trying to take them to court and so on and so forth. You saw that with LVMH and Tiffany's. But often the kind of discount they get is very little or none at all, like we saw with Twitter. And so most of these deals, if you have a definitive merger agreement in place, end up closing at the agreed upon price.
Now, the investors that like these sorts of deals are important to the market because they provide liquidity. I remember a couple of years ago when I owned Livongo and Teladoc wanted to acquire them. Some people said, okay, I have no interest in waiting for this deal to close, so I'm going to take my money and run. And others decided to say, okay, I don't mind owning Teladoc stock after this, so I'll just hold on to my Livongo stock and wait till it converts into Livongo, or wait until it converts into Teladoc. But for the people that want to get out of Livongo on that news, you need big institutional investors to step up and buy it, and then they hold it until closing. So are there funds that are specifically set up just for merger arbitrage, or is it other funds that just do this as like a piece of their business?
Both. So you have several multi-billion-dollar merger arb-focused funds that invest, and they have several different styles, even within merger arbitrage. Some would be highly diversified. They'll invest in every deal. Some are going to be highly concentrated. They might pick only 10 or 20 deals to focus on. So you have merger arbitrage focused funds. You also have a merger arbitrage focused mutual fund out there, potentially an ETF as well. So there are many ways you can invest in it, either as an individual investor or through a fund. And then there are some family offices or there are some other funds that might have merger arbitrage as a portion of their portfolio. And that's how I invest. So I look at merger arbitrage as a replacement to a bond portfolio. So if you take the traditional financial advisor 60-40 portfolio, and you think of 60% as stocks and 40% as bonds, I think of it more as 60% as stocks and 40% as merger arb.
Gotcha. Okay. And it does feel like one of those strategies where you can't just do one. You need a few of them to be diversified. It's like before we started recording, you and I were talking about angel investing, and we both kind of agreed that we don't do it because we can't spend enough time finding enough deals to spread out our risk. Because when you're angel investing, 70% of them are going to go to zero, and you make all your money on the 3 that don't. Not that merger arbitrage is like that, but it feels like one of the strategies where if you're going to do it, you got to do more than just one, so you have your risk spread out. Is that typically what you see?
That's exactly right. I tend to do anywhere from 5 to 10 deals simultaneously, because as you said, some of these deals are going to go through, some might be delayed, and every once in a while a deal is going to fail. So if you have a 90% success rate, you know that 1 out of 10 is not going to work out. And then if you focus on deals that have large spreads, so if your portfolio is filled with Activision Blizzard, Spirit Airlines, Tegna, and so on and so forth, then the risk of failure is higher. So it really depends on how far out the risk spectrum you want to go.
So I just want to share my screen because as you're mentioning some of these stocks, I'm curious to look at the charts.
Sure.
Because my next question is kind of around if somebody wanted to get into merger arbitrage or add this to their investment strategy for some diversification, added alpha, whatever it might be, where do you typically buy these stocks? So like, let's look at Oak Street Health, for instance. Yeah. This was obviously the day that news got announced. Right. In your opinion, based on all the data you've seen, is it better to be early or is it better to wait? Like obviously here, if you waited a few days, you've gotten really no premium. Now, I don't know what the deal price was, so I'm not sure how much over 35.26 you might see from here, but is it better to, if you're going to do 5, 10 deals of these, can you see my screen, by the way?
Yeah, I can see
okay.
it.
If you could do 5 or 10 of these deals a year, is it better to buy it as soon as you can, as soon as you hear the news or hear the rumor?
Yeah, some people do it that way. I like to wait a little bit to see, what the spreads might look like. I like to understand the deal a little bit better. The definitive merger agreement comes out. You read that. You talk to other ARBs. And there's a really great ARB community on Twitter that communicates with each other and shares information. Gotcha. So I prefer to wait a little bit. You really aren't going to lose anything by waiting a little bit. Okay. These deals do take at least 3 to 4 months to close. Yeah. The only ones that tend to close very quickly are the biotech pharma deals. Some of those might close in as little as 80, 90 days.
Really? Why do they close so much faster?
Oh, because it makes a lot of sense. So you have the Pfizers of the world that go out and buy small pharma companies, and these small pharma companies need Pfizer's distribution and marketing networks. So the regulators understand that it really is a win-win for the small company, for Pfizer, and for patients. Gotcha. So most of those go through very quickly, and we did very well with those last year.
Are you still seeing? I mean, because I do agree. I mean, even though I'm not like this huge biotech pharma guy, I do think that big pharma has so much cash on their balance sheets right now. They always have drugs coming up for, coming off patent. So they have to keep filling up their pipeline with new drugs. So I assume that you continue to see more of these M&A deals in the biotech pharma space.
Absolutely. And I think Pfizer has been very aggressive with using their COVID vaccine money to go out and buy their pipeline, if you will, exactly as you mentioned, right? Their drugs come off patent, or, a vaccine is no longer generating as much money as it used to. And so they've been using that money to buy, smaller companies that are in phase 2 or phase 3 that's going to supplement their internal pipeline.
So if we're looking at Oak Street Health right here, like let's say you bought it on, the first day, the second day, now it's trading at 35. Let's just pretend the deal closes at 36 or 37. Will the merger arbs that are in here right now, will they hedge their position somehow? Is there a way to hedge?
Oh yeah, there are ways to hedge. So the Oak Street deal is for $39 a share in cash. Some of these deals could be stock deals. And if it's a stock deal and you want to lock in the spread, you do have to short the stock of the acquiring company.
Right, okay.
But besides that, let's just talk about cash deals. You could hedge this by buying a put option, and that will take off a little bit of the spread that you might pick up otherwise. So it really depends on how much risk you want to take on. The other way to do this would be to buy a call option, and that way less of your capital is tied into the deal. Oak Street Health is $39. It's trading at about 35, 36 right now, 35.28. And so you have a spread of over 10% on that. Amazon just acquired One Life Healthcare, which operates the One Medical set of clinics, very similar business. And these businesses are very similar to what we were talking about in terms of big pharma companies acquiring small pharma companies. These healthcare services companies are not the best business, if you will. Most of them lose money year over year, and they need big platforms like CVS or Amazon or the New York University system to work.
Now, you mentioned that Spirit is getting acquired by who? JetBlue?
That's correct.
I totally lost track of this deal. I mean, I forgot that it was even out there. Is this an acquisition, or is this more of like a merger of equals?
It's an acquisition. If it had been Frontier and Spirit, it would have been close to a merger of equals. JetBlue truly was interested in acquiring Spirit because they lost out on Virgin America that Alaska acquired a few years ago.
Oh, okay.
Yeah.
Because I mean, this doesn't look like your typical stock of a company that's getting acquired.
No, so what happened here was interesting. When Spirit and Frontier were merging and JetBlue came to try to acquire Spirit, Spirit put out a lot of material saying, how it'll be very hard for a combination of Spirit and JetBlue to get through regulators. They essentially made the case for regulators. And so they've given a lot of ammunition to the regulators to say, that this combination doesn't make sense. But when you look at the broader airline industry and you see, Delta out there, United, a lot of the international players on international routes, there is quite a bit of competition. It doesn't make sense for the FTC or the DOJ to block this deal.
So what would this deal happen at?
This deal is at $31 a share. So there's a huge spread on this.
Holy smoke. So, I mean, basically so what exactly is happening here? Like the merger arbs are like, no thanks. Like we're not going near that.
Yeah, there are some merger folks who are in this. I've done this. I normally don't do deals with such huge spreads, but I'm in this one because I like Spirit Airlines as a standalone company. If the deal falls through, I'm perfectly happy owning Spirit Airlines or owning Activision Blizzard.
And if you're buying it here, if the deal falls apart, there's probably not much downside, right?
That's exactly right. The downside is maybe $1 or $2. It probably gets down to $16.
And what's what'd you say the deal price is? Something in the 30s?
$31 in cash.
What?
Yeah.
That's like a 70, isn't that like a 70% premium from here?
Yeah, 73% premium. It's expected to close at the middle of next year. So you do have to hold it for quite some time as it gets
middle of 2024.
That's correct. Middle of 2024.
Holy shit. I didn't know deals took that long.
Well, there was one, I think, Genworth that I think took 4 years and then finally fell apart.
Oh my God, that is a long time to wait. But in this case, so if somebody wanted to play this on the, pretend, like just say, take me, for instance, if I want to, pretend I'm a merger arb guy, would I buy the stock? Would I buy some long dated calls or leaps? Like what's the best way to play this one, you think?
You could buy the stock and sell covered calls on it if you can get any premium on that.
Gotcha.
You can just buy calls that are long dated leaps, as you mentioned, and just wait it out. Or you can just sell puts. That's the other way to pick up some premium along the way.
So what do you think are the chances if this deal goes through next year? And if like, I don't know how a deal like this even goes through. I don't know what the process is, but like, are there different hearings? And based on each hearing, you'd see the stock move higher depending on the outcome of that hearing. And then you just have a bunch of these hearings.
Yeah, so when a deal is announced, they wait for a certain period of time. There's a hot HSR period that happens, and it's about 28 to 38 days. And if that period crosses and the regulator doesn't challenge the deal, then it goes through. Otherwise, there's a second request, there might be a third request. So the regulator is going to reach out to these airlines and ask them to provide some additional information, which then they have to provide within a certain period of time. In certain deals, like the acquisition of Tegna by Standard General, the FCC is involved. In utility deals, you might have the state regulators that might be involved. So really, as you said, it depends on each deal. There could be one or more regulators involved, which is the reason you probably want to avoid insurance deals, because there are a lot of state regulators that get involved in those.
Of all the deals that you track right now on your website, is this the one that has the biggest spread?
This one has the biggest spread. It actually is the second biggest spread. There's another one called Glory Star Media Group. It's a tiny $105 million deal, and that has like a 96% spread on it.
Holy shit. What's the ticker on that?
GSMG.
DSMG?
G as in Gary.
Oh, G.
GSMG.
Yeah, I've never heard of them before. Oh, wow.
It's a tiny deal. I believe it's a Chinese company, or it might be a Chinese company that's acquiring them. And so if you have cross-border deals, you end up with a whole set of additional issues you have to deal with.
So it probably popped here, right, July of 2022, and then it's come all the way back down to where it was before that. So I assume that everyone's betting this deal doesn't happen, right?
That's more likely the case. That's right. I'm not in that one.
I mean, the typical deal, is like Coupa, right? Coupa gets no, is it Coupa?
Yeah.
Wait, I typed in the wrong symbol. It's C. Oh, is Coupa, is that deal already done?
It's already done, yes.
Oh, that's why I can't get the ticker on it right now.
Yeah.
What's another deal that recently got announced, a PE software deal?
Thoma Bravo is acquiring FORG, FORG.
Yeah.
It's also a cash deal at $23.25. It's trading at about $20.26.
So that's interesting. So that's a cash deal.
Correct.
So it would make sense why it jumped up to here. But now that it's actually drifted lower, is there thoughts that that deal might be at risk now?
Yeah, because I believe they did get the second request from the DOJ, the one I was talking about, where they want to get more information from the company. So that did happen with this deal, and that's one of the reasons it dipped lower.
Gotcha. Okay. So outside of merger arb, like other sorts of buyouts or potential buyouts. So like, I know there's talk that Vince McMahon at World Wrestling is putting the company up for sale. And then there was Manchester United is putting themselves up for sale and trying to get all these bidders going. Do you guys cover these sorts of situations as well?
Yeah, we track rumored deals, or what we like to call the deals in the works. And so we track them only when we see them discussed in like maybe Bloomberg or the New York Times or the Wall Street Journal. So we want to make sure we limit it to sources that are, verified media sources. And so we do track those. And it's helpful because if you look at something like Oak Street Health that CVS is acquiring, the rumor about the deal had come out before the actual deal was announced. And so, you track the rumors to understand how much it's jumped up on the rumor, and then how much does it jump up after the actual deal was announced.
Well, this was one that jumped last year, I think, on rumors that they were going to get acquired by maybe Merck. And then those rumors kind of faded. The stock came back down. And then we got new rumors a couple days ago that I think Pfizer is now buying them or trying to buy them. So yeah, this one, that's been a roller coaster for sure.
Yeah. And we've been doing this for several years, and we've analyzed the data, and we've seen about 40 to 50% of these rumors actually turn into real deals, which is higher than I would have expected. But even then, it's like a coin toss. So unless we can find some additional signals in there, we try to limit what we do with pre-deal rumors.
And talk to me about spinoffs. Like, what's a typical spinoff? Like, I know right now you have, I don't know if they're activists necessarily. Maybe there's some activists in there. Maybe it's just the board of directors, but trying to unlock value at companies. So you see like General Electric, spinning off divisions or breaking themselves up. Johnson & Johnson, I think, is breaking themselves up into a couple different pieces. Intel bought MobileEye a few years ago, and now they spun off MobileEye to unlock value. So you guys cover that stuff too?
Yeah, we cover spin-offs. We cover upcoming spin-offs that have been announced and haven't happened yet. And then we also track completed spin-offs to see how the spin-off has performed. How is the parent performing better than the spin-off? Or is the spin-off a better bet, if you will? I don't know if you've read the book, You Can Be a Stock Market Genius, Jonah.
No, I haven't.
By Greenblatt. So if you're interested in event-driven investing or special situations investing, that's a great book. And in that book, Greenblatt talks about investing in the spin-off in the second year after it has been spun out, because you have a lot of forced selling right after the spin-off happens.
I mean, like right now you have MobileEye, I think, coming up on their 6-month lockup.
Yep.
The float on that stock right now is very, very low, because I think Intel still owns like 90 or 95% of the company. So I would not want to be owning MobileEye right now as Intel started to sell down their position, which I assume is the whole point in doing the spinoff in the first place, right? To spin it off and then start to sell it down, take that cash and, buy back your own stock or do whatever they want to do with it.
Exactly. And that's what McDonald's did with Chipotle a really long time ago. So it spun out Chipotle, but still held a majority stake in the company and then eventually sold the rest. And shareholders of McDonald's benefited from that.
How many spinoffs do you see a year?
Oh, you see dozens of them, but the timelines are not quite as clear as mergers. They will announce them and say it might happen in Q4 2023, but that might get extended a little bit beyond that. So we do see dozens of spinoffs each year, but the timelines for them might vary quite a bit.
Gotcha. Okay. And then in the introduction, you also mentioned SPACs, which is sort of a dirty word right now after what happened the last couple of years, but there's still a lot of SPACs out there. There's certainly some value. There's some undervalued ones. So what do you guys do with SPACs?
So we actually use SPACs as a source for short ideas rather than going long. All right. So we love SPACs that are essentially science projects that don't understand what a business really means, that have no intention of potentially making money anytime soon. They're chasing revenue. And they are exploring things, if you will. So we look at some of those, and we look at them as short opportunities.
I mean, some of these SPACs have just been an absolute disaster. I mean, I could pull up 50 charts that all look like this, probably.
Yeah. So one of the biggest one was WeWork. A friend of mine asked me to check it out. I looked at it and I looked at the balance sheet, and it didn't matter what they did in terms of occupancy rates or how much money they, started charging their subscribers, if you will. It was just not a viable business. So when it was about $5, I think we shorted it and we covered it midway through at 250 or 3. It's down to $1 right now.
Wait, so you don't buy their community adjusted EBITDA numbers?
No. We Crashed was a really fun show to watch, but this isn't a fun stock to own. So SPACs are a source of ideas for us, but more on the short side.
So I got sucked into the whole SPAC craze in 2021 because it did look like there were some interesting companies coming public. I sort of felt like, oh, these companies are still in their growth phase versus the more mature companies that end up coming, like a Stripe, for instance. I mean, by the time Stripe comes public, they're going to be growing revenues at like 12% a year. I mean, it's just, all of the growth has already happened. All of the wealth has already been created by the, early investors, insiders, blah, blah, blah. I feel like I'm not going to give two rats asses about Stripe by the time it comes public, but you had all these SPACs that were still growing 50, 60, 70%, or at least you thought they were going to grow because that's what was in these SPAC presentations. And then it turns out most of those lofty expectations or projections were nothing more than complete bullshit for insiders and sponsors to enrich themselves, at the behest of retail investors. So yeah, I agree. I mean, there really hasn't been has there been any sort of pushback from the SEC, any clawbacks? Like, I feel like these guys just all kind of skated away with billions of dollars in profits.
There was pushback from the SEC. They issued new rules. I don't know of any clawbacks, but I'm sure there's going to be investigations and they'll fine a few people. Some of them will receive a slap on the wrist and be let go. But yes, there was some pushback from the SEC once they saw the SPAC bubble, which was significant for the last couple of years.
I mean, one that I got sucked into is App Harvest. You know, I actually thought that this was going to be the future of farming, you know, these indoor vertical farms that were 50 times more efficient than outdoor farming because you can farm year round, you know, in perfect conditions. You can recycle water, you have solar lighting, you know, and nope, not even close. So
yeah. So those are the ones that I like to call science projects. And if we find science project SPACs, we're very happy to use them as short opportunities.
And the other thing that sort of I think caught me off guard, or something, you know, the trap I fell into, is a lot of them had very, very successful, well-known VC firms that were investors. You know, like Desktop Metal is another one that had a all-star cast of early investors, corporate partners. You know, the fact that their corporate partners like BMW was also an investor. You know, you thought that these guys were all lined up to buy their machines once they were available, and it just like it didn't materialize.
Yeah, you're right. The other one that comes to mind, which I'm actually long, because I think some of these completely bombed out SPACs might have an option, the chance of coming back up, is Nextdoor. It was backed by Khosla, and that one did not include any warrants. So they felt like it was such a strong acquisition that they didn't have to sweeten the deal by giving warrants. And so that caught my attention. And after it had dropped quite a bit, I decided to get into Nextdoor.
So what's funny is one of the SPACs I just got into, or former SPACs that I just got into literally a week and a half ago, was Pagaya. So this is sort of like the next Upstart, right? I mean, some of us made money on Upstart, some of us lost money on Upstart. Upstart went up 10x during, you know, the good years, you know, the credit bubble, easy money, and then it came, you know, crashing back down to earth. And Pagaya is sort of in that same business. You know, they're an AI-powered underwriting platform, but they don't do a lot of the stupid crap that Upstart does. You know, they don't bring these risky loans onto their balance sheet. They're really more of a pure fintech company. And they provided guidance the other day for 2023 that was actually pretty good. Like, I was pretty impressed. They actually have revenue growth, like real revenue growth, but the stock's been absolutely destroyed.
Yeah. And SOFI is another one of those, right? SOFI did go public through a SPAC, and I think it has a lot of potential once they can turn things around. Yep,
I agree. I mean, I put together an investment model for SOFI, and I think SOFI could be a $30 company in, you know, 4 or 5 years if a lot of things go right for them.
Yeah, Anthony Noto, the CEO, is great. He came from Twitter, where he was CFO, and then he was a Goldman Sachs analyst before that. So I think they have good leadership. I think it's a great opportunity. The app, I've heard, works really well. It just hasn't, you know, been able to get to profitability yet. Right. If I'm not mistaken.
I mean, so there are still hundreds and hundreds of SPACs out there, and I assume the average SPAC is probably down, what, 90%, 85%?
Anywhere from 50 to 60%. So there's academic research that shows that this isn't just a feature of SPACs, if you let me call it a feature, during this cycle. It's been something that's been going on for many years. SPACs in general have not been the best to bet on, other than to pick up the warrants. So if you're just trying to pick up the few pennies, and when the business combination shareholder vote is held, and you want to basically collect your $10 back and pick up a few pennies, or you want to keep the warrants, that's basically how you would play the SPACs on the long side.
How long do warrants last?
They could be multiple years. I think it's like 2 to 4 years, but I don't know for certain.
Basically until the company buys them back?
Potentially until the company buys them back.
Okay.
Or they get converted into shares.
I mean, because there's, you know, this is another company that I used to follow, Humacyte. You know, apparently they're going to start generating revenues in the next year or so. You know, it's like lab grown arteries and stuff, you know, for surgery. And then eventually they might, you know, create lab grown organs. I mean, like there's, like you said, I mean, a lot of these are just, they're potential science projects that, I mean, they could be massive 50x, 100x winners from here, or they go to zero.
Exactly.
And that's sort of like ASTS is another small position of mine that I got into a couple months ago. around, I think my cost basis is around $6.50 or $6. I didn't pick it up down here at 350, but this is the kind of company that if everything goes right for them, this stock could have massive returns for shareholders. And if everything goes wrong and it goes to zero, like your downside's only $6. Your upside might be $60.
Right. It's kind of like how VCs invest, right? They make a large number of investments, and you have the 3 or 4 big winners that offset all the losses and a whole lot more.
Right. Yeah, I mean, this does now feel like now you're the late stage VC investing in these companies at the valuations in which they should have come public at, not the valuations in which they did.
That's exactly right. It was a bubble. Everybody used the opportunity to go public, whether the company was ready or not, which in many cases they weren't ready to go public.
So what sort of information regarding SPACs do you guys have on your website? I mean, is there a list of like your top 10 SPACs, or, I mean, how do you guys do it?
So we track every single SPAC IPO that has been announced, and then we track the split between once the unit splits into the stock and the warrants, we track that, and then we track the business combinations and when they happen. So basically all the data around SPACs. We don't write about them quite as much as we write about merger arbitrage or insider transactions or spin-offs, mostly because it just hasn't been an exciting area to focus on for quite some time now.
Right.
So we look at it on the short side, but mostly it's about providing data to people who want to look through all the SPACs to find opportunities.
Yeah, I mean, see, my concern is like I write a newsletter on Substack and I publish a weekly piece on a different growth company. And even though I think some of these former SPACs have potential, there's still a lot of risk there. There's unproven management teams. There's a lot of bad blood. There's, obviously the projections they provided turned out to be complete bullshit. And unfortunately, a lot of them have burned so much cash that they're going to have to start raising more capital. And when you raise capital and your stock price is at $2, you're talking some massive dilution happening.
Exactly. And so one of the signals we look for is insider buying. And there's 2 kinds of insider buying. There's one kind of insider buying where, they truly believe the stock is worth a whole lot more and it's been unfairly punished by the market. And then there's the other kind where they're just trying to signal the market. They know that people pay attention to insider buying and they'll buy it just so that, people will get interested and look at the stock or buy it.
So those are the CEOs that I like to make fun of because, they sold $1 billion of stock, a year and a half ago at the highs, and then they do a $5 million insider buy, as the stock's near its lows. And it's like, I don't really put any value in that. I mean, you sold $1 billion of stock. Now you're buying back 5 million. Like that's basically a rounding error for you now. So
that's exactly right. So we try to distill the signal from the noise in these transactions. And it's hard to do because so many of them are buying it just because, they want to signal the market. But you have some really interesting situations like Lionsgate Entertainment last November and December, where 3 different directors and the CFO bought a lot of shares. And these are directors that have been involved with the company for a really long time, and the stock just shot up after that. So it's done very well since those purchases at about $6 a share. You have the CEO of NRDY that bought a bunch of shares last year, and they've been doing quite all right over the last several weeks. So you have specific situations where you really need to get in and understand the company and understand why the insiders might be buying.
Right, because I've always said that insider buying is sort of like insider trading, but in a legal way, because the people that know the company the best, that know where the financials are right now and where they might be in 6 or 12 months, if they're buying stock and it's a meaningful enough purchase for them, then it is a pretty strong signal. But Jeff Lawson from Twilio buying $10 million of stock, after selling $1 billion or whatever he sold, just like if Evan Spiegel from Snapchat bought $10 million of stock, like that's not a signal because the guy's already sold like $3 billion since the company went public.
Yeah, or the ASAN purchases by Dustin Moskowitz. He kept buying all the way down, if you remember that one. Right. So
there should be like in the dictionary under dollar cost average, there should be a picture of Dustin Moskowitz.
Yep.
I mean, he was buying like 120 all the way down to like $20. I think he now owns like half the company.
Yeah, he already had a very huge position in the company. He made his money at Facebook, and he was buying when it was 50 times sales, 60 times sales. It just made no sense. But I think he mentioned that publicly as well, that his insider purchases were misguided. So, you know, at least he said that out publicly.
I mean, here's the chart for Asana. I mean, he was literally buying up here, I think, all the way down.
Yep.
And unfortunately, a lot of investors saw him buying and said, oh, he knows something that we don't know. You know, they're about to report some blowout numbers, and everyone just got sucked into that.
Yeah, so in many ways, insiders are misguided, right? So they have the same biases that you and I have. They have anchor biases where they look at the price, it's been high, all of a sudden it's down 30, 40%, and they feel like, you know, that's not justified. But they're not fundamental investors. They probably don't know how to value the company. They don't know how to run a DCF model, if you will. So while they understand what's happening with the company, while they know what's coming down the pipe, they might not truly be people who value the company the way investors do. I think the other blind spot for them is they don't understand what is happening in the broader economy or within the industry quite as well as investors might. So that's another thing they miss.
What are some other companies right now that are popping up in terms of insider buying where it actually is or could be a strong signal?
Lionsgate was good a couple of months ago. NRDY is good. And then let me pull up my list. Let's see.
I know, I mean, you always see some from like the guy that I always think of is like the Kinder Morgan guy. I feel like he's always buying, you know, big chunks of stock.
Yeah, Energy Transfer was another big one. It's another oil midstream company. We saw a lot of buying last week. Kelsey Warren, he was the founder of the company.
Okay.
When I see a founder who's been at the company for decades, or I see a chairman of a company that's been there for several decades, and they understand the cycles and they've seen multiple cycles, I get excited by those.
Because it does feel like over the last, call it 2 years, the amount of insider selling to insider buying in growth stocks is like 100 to 1. Like there's been like no buying, it's all selling.
That's exactly right. And I'm glad you brought that up, Jonah, because what we normally see in any given week, we calculate the sell-buy ratio, how many insiders are selling versus how many are buying. And insiders sell anywhere from 10 to 20 times as much as they buy in any given week across the whole group of stocks.
Interesting.
In 2020, towards the end of March 2020, for the first time in over a decade, we saw insider buying surpass insider selling. And so that was a strong signal for me to actually start considering going on the long side.
Huh. Okay. Yeah, because one of the other CEOs that I was talking smack about recently was the founder of Zoom, who recently took a pay cut, but he's already sold billions of dollars of stock in the last couple of years. Like, what the hell is a pay cut going to do? Like, come on, like the shareholders will do anything, like anything like that. They get all giddy and excited about a CEO taking a pay cut or a CEO buying a little bit of stock after they just dumped, 90% of their position or their shares in the last couple of years. So, but yeah, I mean, I agree. Insider buying when it's meaningful.
That's right.
What about do you guys track like corporate buybacks?
We do, yeah. So we track corporate buybacks as well. And one of my favorite screens is what we call the double dipper, where the corporate entity is buying back its own stock and the insiders are buying simultaneously at the same time. So we've created a custom screen called the double dipper that looks at both corporate buybacks and insider buying.
Is there any stock right now that pops up on the double dipper screen?
Quite a few. Give me a second, I'll pull it up. One of the ones I was looking at recently was a car rental company, Avis. And so the symbol is the Avis Budget Group. The symbol is CAR, car.
Oh, okay. I honestly didn't even know that insiders could be buying at the same time that the company was buying.
Oh yeah, they can. Usually it's, they might buy a few weeks or months before. So we do like a 6-month or a 1-year look back period.
Oh, okay.
So in the case of Avis Budget Group, the executive chairman had been buying in mid-2022, and they've been buying back their own stock for several years. From what I recollect, they've retired like 35-40% of their stock through buybacks. What
sort of data do you have around corporate buybacks? Because, for instance, Salesforce, ticker symbol CRM is up big today. They reported earnings yesterday. they announced a $20 billion buyback, although like sometimes these companies play these games, they announce a buyback, but it's really just including the last buyback. So it's not like, you know, if they already had like an outstanding $10 billion buyback and they announce a 20 billion buyback, they're really just announcing another 10 billion on top of the previous 10 billion, but shareholders still go crazy over it. But they don't really even, some of these, like, just because they're announcing a $20 billion buyback doesn't mean they're going to buy back 20 billion of stock. And it might take them 2 or 3 years to do it, right?
That's exactly right. It might take them a long time to do that. Goldman announced a massive buyback earlier, and there's no timeline to that.
Goldman doesn't even have $30 billion on their balance sheet.
Right. So
that's what I said. Like, where the hell are they getting $30 billion? Like,
that's exactly right. And so what you see is they announce these buybacks that might take a really long time to happen. Some of them are just offsetting shareholder dilution, right? Because of the stock-based compensation and so on and so forth. So what we do, Jonah, is we track multiple things. We track the announcements and we distinguish them between new announcements versus additional announcements. And then we track the actual shares outstanding from the 10Ks and the 10Qs to see if it's actually going down or not. And so when we look at those announcements and right next to that, we look at what's happening with shares outstanding, we can pick up on whether it's a real buyback or if it's just offsetting dilution.
Yeah, because sometimes I feel like, you know, you said before, you know, a signal from the CEO. I feel like sometimes these buyback announcements are really just that, you know, it's this, it's the board or the management team saying, hey, we think our stock is too cheap right now, so we're going to announce a big buyback, even though we know in the back of our minds that we might actually not buy back all of that stock, you know, or it might take us a long time. You know, this is our way of telling you that we think our stock is cheap right now and you should buy it.
You're right. So the way we approach this is we look at all of these strategies as idea generation strategies, right? So it's an idea generation platform for us, but you have to do the extra work to understand if this company makes sense or not. Just because the insider's buying or just because they announced a buyback, it doesn't really mean anything. You can't go buy the stock based on that.
But there is something to be said for companies that do buy back their stock to the extent that it lowers the number of outstanding shares and therefore boosts EPS, and therefore hopefully the stock is able to, you know, get a higher multiple because of a higher EPS growth rate because they're retiring stock. I mean, I forget exactly which company it is. It might be Old Dominion. Maybe it's what's TSCO? Like some of these stocks that have been Tractor Supply, some of these stocks that have been the best performers over the last 10, 15, 20 years are also the companies that are buying back the most stock, you know, over the last 10, 15 years. Look at Apple. I mean, ever since Apple started buying back their own stock, you know, the stock's up, I don't know, 10x, 20x over the last decade.
Yeah, exactly. You have these cannibals. Apple is one of them. AutoZone is another one.
Oh, yeah. Yep.
The home builder, NRDY. I forget the home builder's symbol right now. But they buy a lot of stock. Avis Budget Group has been buying back a lot of stock, and Avis Budget has done really well over the last 2 years, despite the bear market and everything.
So if you go to, like, so sometimes I'll go to Koifin. I don't know if you use Koifin at all. You probably, I mean, I'm sure you guys have data flowing through your own website.
Yep.
This is just one place where you can track, you know, outstanding shares, and you can see how it's trended. Outstanding shares. And if you do like, let's see, you know, 10 years. Oh, wait, hold on. Oh, that's EV to sales. Shares outstanding. There you go. Yeah, there you go. I mean, so there's AutoZone. I mean, that's what you want to see from a stock, right? Down and to the right.
Exactly. So you're going to see them with some of those cannibals that are known to buy back a lot of their stock.
Versus you look at CRM and that's going the wrong way.
That's exactly right. Yeah. If I could share my screen for a minute, Jonah.
Oh, yeah. I want to look at Meta too, because I'm sure Meta, you see Meta. So Meta did a lot of stock buybacks. They just did stock buybacks when the stock was near the all-time high.
Right. And they're going to do some more now. So now is a good time. I hope they bought some in Q4 of last year. It would have been a great time for them to do that.
So let me figure out how to give you screen sharing capabilities. Where is that? I just had it. Oh, here it is. Hold on. Multiple. Okay, you should be able to share your screen now.
All right. So if you can see my screen.
I can't see it yet.
Right. Let me know when it comes up.
Not yet.
All right, let me see if I can stop sharing and share again.
Oh, maybe I think I have to stop sharing. Oh yeah, okay, now I got it. Yep. Avis.
Yep. So I have Avis budget group pulled up on inside arbitrage, and obviously the price chart and so on and so forth. But down here after the insider transactions and the 13F fund positions, we have the shares outstanding. And you can see how they've been buying back quite significantly, especially over the last 5 quarters.
Is there I know there used to be, I assume there probably is, there's an ETF that invests in the stock, in the companies that do the most stock buybacks, or
there used to be 2 ETFs for insider buying that I was aware of, but not the buyback one. I should look at that to see what's happening there.
I feel like that'd be a no-brainer for an ETF too.
Right.
Because I mean, I do think a lot of those companies that buy back the most stock, as a percentage of their overall float, do tend to perform better over the long term than the companies that are constantly diluting their shareholders, like a Snowflake. I mean, like all these high growth companies that, I've been on the SBC train for a while now. I created an entire spreadsheet to track, 300 companies and which ones are the worst SBC offenders. And a lot of them are, the amount of SBC they give out, and, a lot, it looks bad right now because their stock prices are down 70 or 80%. So, SBC as a percentage of their market cap looks really bad, but still, like CoinDesk, for instance, is it CoinDesk or Coinbase? I can't even remember. I mean, they're, them and Zoom and DraftKings. I mean, they're giving out like $1 billion of stock a year and just keep losing more money, diluting shareholders. Like that's a train. That's a train crash I don't be part of.
That's exactly right. I was looking at this company that had $1 billion in losses, and pretty much they gave out $1 billion in stock-based compensation.
Jesus.
So pretty much all the money they made was gone in terms of stock-based compensation. So
that's brutal.
Not good for shareholders. Yeah.
I don't want to take up the rest of your day. I know you still have a full day ahead of you. It's now after 4 o'clock here. Before we wrap up, anything else you wanted to share? The website is insidearbitrage.com, right?
That's right. Yeah, so we publish something called our event-driven monitor, which is a free thing that goes out before the market opens every morning, and it includes all the information about new mergers, insider purchases from the previous day, management changes, so on and so forth. So your subscribers might find that useful if they want to check out what we do. And then, as I mentioned, it's 7 different strategies on the website that we track.
Awesome. Yeah, I'll add that to all the notes when we post the interview online. So, well, Asif, thank you very, very much for being a guest today. Really enjoyed this. Hope you come back again sometime, because I felt like I learned a lot today, and I'm sure the viewers did too.
Thank you, Jonah. I really enjoyed the conversation.
Thanks for being here. Talk to you soon. Bye.
Take care. Bye.